All right, let's get right into it. Welcome to This Explainer. Today, we're completely demystifying a system that literally rules our daily lives, but is almost entirely misunderstood. We're talking about our financial system. We're unpacking an incredible documentary that pulls back the curtain on where money actually comes from. We'll get into the mechanics, the history, and some pretty shocking realities of global finance. Trust me, by the end of this, you're never going to look at a bank statement the same way again. So how is money actually created? Seriously, think about it for a second. Where does it come from? I mean, most of us grew up with that classic piggy bank myth, right? You work hard, you earn your money, you put those savings in a bank, and then that bank lends your hard-earned cash to somebody else to buy a house or start a business. It makes total sense. But as the documentary points out, that childhood myth, it's completely false. To give you an idea of the sheer scale of this illusion, check out these numbers. In the UK back in 2010, they had a staggering £2.15 trillion money supply. But out of all of that, only 2.6% was physical cash, the actual notes and coins created by the government. The other 97.4%, that is what's called commercial bank money. That means the vast, overwhelming majority of the money in our entire economy is created entirely by private banks. You see, there's this massive disconnect between what the public believes and economic reality. We've all bought into the idea that banks are just these simple middlemen, patiently guarding your deposits and lending them out. But the reality? Banks don't lend out existing money at all. They literally create brand new digital money out of thin air every single time they issue a loan. It's really just numbers typed into a computer system. Okay, so the absolutely crucial concept to grasp here is commercial bank money. At the end of the day, it's nothing more than an accounting entry. And what that means is that in our current system, money literally equals debt. If there were no debts, there would be virtually no money in the economy. The exact moment a bank issues a loan, new money is born. And the moment that loan is paid off, that money is destroyed. But the bank? Well, they get to keep the interest as profit. Let's walk through exactly how this happens, because it's pretty wild once you see it. Step 1, a customer requests a loan, let's say for a mortgage. Step 2, the bank doesn't head down to a vault to see if they have enough savers cash. Nope. Instead, they invent a liability. They basically pretend you deposited the money and they just type that loan amount into your account. And step 3, brand new commercial bank money enters circulation the second you spend that credit. It really is just an accounting trick. Now, I know exactly what you might be thinking. You're thinking, this sounds like some crackpot conspiracy theory, but it absolutely isn't. Just listen to this quote from Paul Tucker, the former deputy governor of the Bank of England. He stated plainly, when banks make loans, they create additional deposits for those that have borrowed the money. The documentary emphasizes this just to prove that this isn't a fringe idea. It's documented, official central bank policy. It's just a reality that's super poorly understood by the general public. To really hammer home just how absurd this system is, get a load of this number, £1.2 trillion. Between 1998 and 2007, private banks created £1.2 trillion in new money. During that exact same period, the state treasury created just $18 billion. That means the private banking sector essentially holds the keys to the kingdom. They are effectively deciding how and exactly where almost all new purchasing power is allocated in society. Section 1. The domestic ripple, debt, housing, and inflation. So because banks are businesses trying to minimize their risk, they naturally prefer lending against solid collateral. Take August 2011, for example. A massive 85.5% of consumer bank lending was directed toward mortgages on dwellings, rather than, say, productive small businesses. Why? Well, if a small business goes under, the bank might get nothing. But if you default on your mortgage, the bank just takes your house. So they have this massive incentive to pump all this newly created money straight into the housing market. And that leads us directly to inflation, which is basically defined as too much money chasing too few goods. When banks pump hundreds of billions of newly created digital pounds into the housing market, it's not like they're building new houses or increasing actual economic output. That money is just chasing the existing housing stock. And that creates massive speculative price inflation. It makes the wealthy feel wealthier, sure, but it forces the next generation to take on even more debt just to keep a roof over their heads. Ultimately, this debt-based system practically guarantees a brutal boom-bust cycle. Here's how it plays out. Banks create money by issuing easy credit, and that causes a speculative economic boom. But eventually, people become over-indebted. Defaults start rolling in, exactly like we saw with the subprime mortgage crisis. Those defaults ripple through the entire economy. The banks get scared, they stop lending, the money supply shrinks, and bam, we fall right into a recession. It is an inherently unstable loop. Section 2. The Global Ripple, Currency Wars and Imperialism. So, historically, how on earth did we get here? Well, back in 1637, the Dutch tulip bubble gave us our first taste of a massive financial crash fueled by early financial innovations. Fast forward to the 1844 Bank Charter Act. The UK government tried to take back control of paper money, but they completely missed regulating digital demand deposits. Huge oversight. Then we get the 1944 Bretton Woods Agreement, pegging world currencies to the dollar and the dollar to gold. But the real game changer was 1971, when the US unpegged the dollar from gold, completely removing any physical commodity backing our money. That 1971 decision officially kicked off the era of pure fiat money. Fiat money is backed by absolutely nothing except confidence. And what's really fascinating here is the actual etymology of the word credit. It comes from the Latin root credere, which literally means to believe. Our entire global financial system today functions simply because we all collectively believe that those digital numbers on a screen actually hold value. Because our money isn't backed by physical commodity and just floats freely, it opened the floodgates for massive global speculation. Just look at this figure. By 2010, $4 trillion of currency was being traded every single day on foreign exchange markets. To put that into perspective, it only takes a few weeks of this trading to equal the entire global GDP for a whole year. And the vast majority of this isn't for buying actual goods or services. It's pure speculation. It's just making money from money. Now, the documentary argues that this system paves the way for what it calls financial imperialism over vulnerable nations. Take a look at institutions like the IMF. When a developing country faces a debt crisis, the IMF will step in and offer bailouts but with very strict conditions attached, known as structural adjustment programs. Now, the acclaimed goal is to encourage investment or solve the debt crisis. But according to the documentary, the actual results often involve forcing cuts to public spending, destroying local industries, stripping away national sovereignty, and ultimately trapping the country in even deeper debt to international capital markets. This brings us to a really provocative claim presented in the documentary. The governments don't rule the world, Goldman Sachs rules the world. The film uses this quote to highlight a startling trend they observed during the European debt crisis. They noted that unelected former investment bankers were being placed into high political offices, like prime ministers and central bank presidents, basically to enforce debt repayments. The documentary uses this to raise some massive questions about democracy when technocrats are installed just to ensure the banking system gets paid above all else. Section 3. The absurdity. Who really benefits? The documentary's core, and honestly quite sobering finding, is this. A debt-based money system intrinsically distributes money from the poor to the very rich. Because every single pound in existence is created as debt, someone, somewhere, is paying interest on it. And that debt typically falls on the lower and middle classes. The interest they pay funnels directly upward into the banking sector, funding massive profits and bonuses. It's essentially a hidden, highly regressive mechanism for wealth transfer. To highlight the sheer absurdity of all this, the documentary features a darkly comedic spoof called the Adopt a Banker Foundation. It's a sharp satire on how taxpayer bailouts essentially protected the luxury lifestyles of the very people who crashed the system in the first place. The spoof asks ordinary taxpayers to donate £395 for a banker's champagne, £900 for their Aston Martin tires, or $2,000 for a Savile Row suit. It's a pretty biting commentary on a system that privatizes immense profits during a boom, but then socializes the devastating losses onto the public during a bust. And that brings us to a final question I want to leave you with today. If private banks literally create our money out of thin air, based purely on our willingness to take on debt, who are we really working for? Are we working to build a productive society, or are we simply working to pay interest to a system that prints money from nothing? It's a deeply provocative thought, but after going through the evidence in this explainer, I really hope it sparks your curiosity to keep questioning the financial world around you. Thanks for joining me, and keep learning.